Budget 101 is a training that will provide an overview of the county budget so that the public can gain a better understanding of what makes up Jefferson County's revenues and expenditures. It will also give a better idea of how the budget relates to the services Jefferson County provides to the community. So what is a budget? A budget is a financial plan for one fiscal period. The county's runs from January 1st to December 31st. It is also a forecast of a future fiscal period to achieve the Board of County Commissioners' vision, mission, values, priorities, and goals. When creating the budget, there are certain statutory and constitutional requirements that the plan must follow. In the upcoming slides, we will discuss the meaning of some of these requirements. What is TABOR, also known as the Taxpayer Bill of Rights? TABOR is designed to limit the growth of government by how much a government can spend and how much revenue it can keep. It's tied specifically to countywide growth in new construction and inflation. Here's what it means right now for taxpayers in Jefferson County. The county has been collecting more revenue than it can keep under TABOR. The loss of this surplus funding has a direct impact on the level and quality of services the county can provide to its residents. From 2015 to 2019, Jeffco hit the TABOR cap every year, leaving a total of $111 million on the table, dollars that the county could have reinvested in roads, bridges, public safety, facilities repair, mental health, and other areas that enhance our quality of life and well-being. It is important to note that grant funds we receive from the state are included in our TABOR limits. This is important because when the county accepts a grant that is TABOR limited and we have already received all the revenue we are allowed for the year, the grant has the unintended effect of reducing funding for other important programs. So where exactly do your property taxes go? For every dollar that the county collects from property taxes, 24 cents remains with the county to provide services. The other 76 cents goes to public schools, special districts, and cities. Another term to discuss is a mill levy. A mill levy is a property tax that is based on the assessed value of a property. The rate of this tax is expressed in mills. 1 mill is equal to $1 for every $1,000 of assessed value. When it comes to the county's budget, it is important to note that there are many different funds. The county has different funds or buckets of money, most of which can be used only for specific purposes based on the source of funding. Another important term to know is revenue, which is the money received by the county. The county's primary source of revenue is taxes, primarily property taxes. However, half of the county's revenue comes from other sources such as these. Now let's turn our attention to the county's expenditures. An expenditure refers to the money that the county spends to conduct operations and maintain assets. The county's expenditures are broken down into the following categories. If expenditures are projected to exceed revenues, just as with a family budget, the county must make adjustments to either increase revenue, decrease expenditures, or a combination of both. This occurs annually as part of the strategic budget planning and analysis process. At Jefferson County, we believe it is important that our residents understand how our budget works so that they can be engaged in the budget process, provide their feedback to county leadership on what is important to them, and to help us be better stewards of county resources.